Bitcoin transactions are defined using a Forth-like scripting language. Transactions consist of one or more inputs, and one or more outputs. When a user sends Bitcoins, the user designates each address, and the amount of Bitcoin being sent to that address in an output. To prevent double spending, each input must refer to a previous unspent output in the blockchain. The use of multiple inputs corresponds to the use of multiple coins in a cash transaction. Since transactions can have multiple outputs, users can send Bitcoins to multiple recipients in one transaction. As in a cash transaction, the sum of inputs, coins used to pay, can exceed the intended sum of payments. In such a case, an additional output is used, returning the change back to the pair. Any input satoshis not accounted for in the transaction outputs become the transaction fee. Paying a transaction fee is optional. Miners can choose which transactions to process, and prioritize those that pay higher fees. Fees are based on the storage size of the transaction generated, which in turn is dependent on the number of inputs used to create the transaction. Somehow, Bitcoin is a currency, and a commodity. Fundamentally, Bitcoin is a secure system for storing and exchanging money anonymously on the internet. In some contexts, it works like untraceable money for, say, buying drugs on the darknet. In others, it works like a safety deposit box without a bank, like when it is used to store money away from the prying eyes of governments. In others still, it is a tradable financial asset like a stock or bond. You could use Bitcoin to become a millionaire. But each of these metaphors has limitations. Unlike most currencies, Bitcoin is not supervised or endorsed by any government. It has incredible price volatility, which also makes transactions complicated and undermines the safety deposit box approach. And, unlike the stock market, where valuations are based at least theoretically on expectations of future company value, there is no fundamental basis of speculative value for Bitcoin. Bitcoin trading is very risky. And even setting aside the long-term case for Bitcoin, in the short and medium term the currency is terrifyingly volatile. For example, in early 2017, one Bitcoin was worth about $900. About a year later, it was worth about 15 times that amount, but also very stressful to Bitcoin investors. Within 1 week in December 2017, Bitcoin hit a high above $19,000, dropped to as low as $10,400, and then climbed back up above $15,000 24 hours later.